Very good morning, my dear soldiers. So, before proceeding with today's session, let me give a quick recap related to yesterday's session. So, reconstruction is a word in generally when we are using, right? We started with that particular word. So, reconstruction will be useful at the time of when the corporates are facing huge losses since past few years to revamp their financial statements at true and fair view. In generally, companies will either go for external reconstruction or they can go for internal reconstruction. In case of external reconstruction, the existing company will be liquidate and a new company is incorporated to take over that existing company. In case of internal reconstruction, without liquidation of the existing company itself, the financial statements are internally revamped. So that we are going to see in our next chapter under the chapter name internal reconstruction. That's why I don't give much introduction related to internal reconstruction. We will discuss top to bottom in that particular chapter. And apart from the word external reconstruction, we also just explained two more words. One is amalgamation and the other one is absorption. In case of amalgamation, a new company is incorporated to take over two or more existing companies. In case of absorption, an existing company is going to take over another existing company. As you know already, in case of external reconstruction, a new company is incorporated to take over an existing company. So, even though conceptually all these three are different concepts, but why we are correlating all these three to each other? It is very easy. There are two different companies exist. One is purchasing company and the other one is selling company. The company which loses its existence is a selling company. The company which is going to acquire, we can call it as a purchasing company. So various terminologies they are using. Either selling company, people are also call it as transfer company. Purchasing company, people are call it as transferee company. If it is pure amalgamation, so people are also calling with these names. Selling companies, they are calling it as amalgamating companies. Amalgamating companies. So purchasing company is amalgamated company. So like that, various terminologies they may use, but the ultimate meaning is either selling company or purchasing company only. Then after that, we discussed our entire discussion towards the concept of amalgamation. In the problems, whenever they are using the concept of amalgamation, it includes absorption as well. I clearly mentioned such fact. So basically, there are two types of amalgamation is possible to decide the accounting treatment in the books of purchasing company actually. That is amalgamation in the nature of merger and amalgamation in the nature of purchase. A particular amalgamation is said to be amalgamation in the nature of merger. Any of the below, no, all of the below five conditions should need to be satisfied. That is, all the assets and liabilities of the selling company should be taken over by the purchasing company, and all such assets and liabilities should be taken over at book values only. PC should be discharged in the form of fully paid up equity shares only by the purchasing company to the selling company, and the shareholders holding not less than 90% share capital in the selling company should become the shareholders of the purchasing company through this virtue of amalgamation. That means whatever the PC is issued by the purchasing company, it should be issued to the shareholders of the selling company. Then only it is possible at least 90% of the shareholders will automatically become the shareholders of purchasing company. And purchasing company will continue the same line of business of the selling company post acquisition. Here, yesterday, just intentionally I forgot to add two things. That is, sir, coming to third point, you told that the entire PC is in fully paid up equity shares only. Sir, sometimes how it happen, let us assume the purchase consideration is 10 lakh 52,234. which is a PC. Just a figure just I given for our understanding. The issue price issued by the purchasing company is around, you can consider 30 rupees, let us assume. Then may I know how many number of shares need to be issued by purchasing company to the selling company? Please all of you participate. Put it the figure in the queries box, which is around 35,074.47. Sir, is it possible to issue fraction of the share here 0.47? Is it possible? No. So that's why it is clearly mentioned that for a fraction of the share, the purchasing company can able to issue cash. Based on this fact, we cannot conclude that amalgamation is amalgamation in the nature of purchase. Sir, all the shares are not fully paid up equity shares, sir. For fraction of the share, purchasing company issued cash. So that's why they violated condition number 3. So that's why which is amalgamation in the nature of purchase. We cannot conclude like that. For fraction of the shares, purchasing company can able to issue cash, that is other than equity share. Also, PC will be possible in case of merger. Do you agree? Next. And coming to fourth point. So what is the special issue here? For example, two companies are there. One is A Limited and the other one is B Limited. Sir, A Limited share capital is 10 lakhs, let us assume. Before amalgamation itself, B Limited hold 1.5 lakh worth of equity shares in A Limited. This is not at the time of amalgamation. Before the amalgamation itself, B Limited and A Limited have some relationship. Or B Limited acquired the equity shares of A Limited. Now, this 90% of share capital concept is applicable not on 10 lakhs, 10 minus 1.5, 8.5 lakhs. Now let us assume A Limited and B Limited amalgamated with each other, are absorbing each other. Now, to put the amalgamation as amalgamation in the nature of merger, out of this 8.5 lakhs worth of shareholder, at least 90% of the shareholder would become or need to be become the shareholders of the B Limited post amalgamation. I mean, what I want to try to tell here, this 90% should need to be reckoned for the net amount of the share capital. Net amount of the share capital means after deducting the investments made by the purchasing company in the selling company before amalgamation. So these 2 points intentionally not discussed in yesterday's session, just I'm covering in at the time of revision. Hope you understand. Now come down. Sir, what are the 3 major topics we are going to discuss in this particular chapter, sir? That is accounting treatment in the books of selling company, purchase consideration, accounting treatment in the books of purchasing company. As I already mentioned you, AS 14 is applicable for calculation of PC and to decide the accounting treatment in the books of purchasing company. But AS 14 doesn't applicable to provide accounting treatment in the books of selling company. And as I already mentioned, in the books of purchasing company, accounting treatment is depending upon type of amalgamation, that is amalgamation in the nature of merger and amalgamation in the nature of purchase. Just now we discussed when the amalgamation is said to be in the nature of merger, when the amalgamation is said to be in the nature of purchase. So if the amalgamation is in the nature of merger, then the method of accounting treatment is pooling of interest method. If the amalgamation is in the nature of purchase, then the method of accounting treatment is purchase method. Right? Fine. Sir, we intensively discussed the concept of purchase consideration. So let me quickly revise the purchase consideration as well. Then I'll move on with accounting treatment in the books of selling company. As per AS 14, PC is nothing but amount payable by purchasing company to the shareholders of the selling company alone. Sir, shareholders of the selling company means either it can be payable to equity shareholders or preference shareholders. One more important thing also I mentioned, what we are paying is completely irrelevant, to whom we are issuing is relevant. You may pay cash or equity shares or preference shares or debentures or in any other form or in any other asset. But if it is issue to or if it is payable to shareholders, then it is form part of purchase consideration. So various examples also I given for better understanding of this provision. Next, coming to methods of PC. Popularly, there are four methods exist: net payments, net asset value method, intrinsic value method, lump sum method. In case of lump sum method, the consideration will be directly mentioned in the agreement itself, here in the problems itself. But in case of net payments, net asset value or intrinsic value method, we should need to calculate the PC. Net payments method is nothing but amount payable to equity shareholders of the selling company need to be sum off with amount payable to preference shareholders of the selling company, then we will get the PC. In case of net asset value method, assets minus outside liabilities taken over by the purchasing company at the rate of agreed values we need to consider. Because whatever the book values were placed in the selling company are ultimately irrelevant to decide the price for the selling company. So to decide the price for the selling company, I will put my agreed value. I will check the agreed value. Here, the book value of the selling company is irrelevant. That's why we should need to consider the agreed values. This point is important. So most of the times the student may commit the mistake that they may put here the book values. So please have a look. Then coming to intrinsic value method, as I already told to you in yesterday's session, there is no difference between NAV method and intrinsic value method. Both are same, but the way of expressing the values quite be different. In case of intrinsic value method, the number of equity shares present in selling company multiplied with intrinsic value per share in the selling company or NAV per share in the selling company. Right? So then how to identify which method is suitable for my problem? For this also the logics I told you. Uh, if you by reading the information, if you can simply able to ascertain amount payable to equity shareholders and preference shareholders, then the method of PC is net payments method. Some information is missing, sir. Some hidden information is there, sir. We are unable to find out the amount payable to equity shareholders, let us assume. Then straight away you can go to the net asset value method. So in problems, something like that, they will tempting you. It will look like net payments method, but you are unable to work out. Then at that moment, you should need to apply net asset value method. But ultimately, to know the mode of PC, you know the total amount of PC by applying NAV at that moment. To know the mode of PC, again, you should need to bifurcate how much amount belongs to equity shareholders, how much amount belongs to preference shareholders. For that purpose, you are using the net payments method, not for the purpose of calculation. Hope you understand my point here. And one more important fact I also discussed. So PC may be recorded at issue price or PC may be recorded at par value. If nothing is mentioned, in general, we are going to record PC at issue price. Then whatever the methods I suggested above, the same method simply you can apply. You will get the PC under issue price. But if in the problem it is clearly mentioned that you should need to record PC at par value, then first you should need to work out number of shares issued as PC. Then you should need to multiply with face value or the par value. Then how we will get number of shares issued as PC? Number of shares issued as PC is nothing but the above computation formulas. For example, like this, you should need to calculate the PC under net payments, like this under NAV, like this under intrinsic value. Once you calculated these, you should need to divide these by issue prices. Then you will get number of shares issued as PC. Then you should need to multiply with the face value. Then you will get PC is recorded at a par value. So I told you one complicated issue. If the PC is under lump sum method, sorry, if the PC is under intrinsic value method and PC is recorded at par value, then how I should need to calculate the PC? Then this is the formula you should need to apply. That is, first under intrinsic value method, how you are going to calculate the purchase consideration, number of equity shares in selling company multiply with intrinsic value per share in selling company. This is the normal computation. But first here I require number of shares issued as PC by the purchasing company. To know that, you should need to divide the figure with issue price in the purchasing company. Issue price in the purchasing company means purchasing company is going to issue for their own intrinsic value. That's why you should need to divide with intrinsic value per share in the purchasing company. Then you will get number of shares issued as PC by the purchasing company. If you multiply with the face value, then you will get PC is recorded at par value. Hope you understand this one more time. Fine, guys. Then I started in the yesterday session itself accounting treatment in the books of selling company, but just due to lack of time frame, so just I left there. Hope you guys, all of you with me. It's fine, right? Shall I continue? Can you give anyone some thumb symbol, thumbs up symbol, something like that? Then can I start with accounting treatment in the books of selling company? Yeah, fine. Sir, as I already mentioned, AS 14 doesn't applicable to selling company books. Then which type of accounting treatment I should need to provide, sir? That is, simply you should need to provide accounting treatment related to closure of the books of accounts. For that, the generally accepted accounting procedures are the principles you can apply. Now, so let me take an example for this. So this is the example. So what this example is all about. So a typical balance sheet I considered where PPE is there, intangible assets exist, fictitious assets are there, remaining all are current assets. Coming to equity and liabilities, equity share capital, preference share capital, reserves and surplus exist. And non-current liabilities, 10% debentures is there, current liabilities, trade payables is there. So additional information like some points were given. Except cash, purchasing company want to take over all assets and liabilities. That means out of the existing assets, except this cash, remaining all assets, remaining all liabilities are taken over by purchasing company. One thing you should need to remember, liabilities is different, equity is different. Even though those are placed under liability side, this form is not the liability. This form we can call it as equity. Equity means shareholders worth or net worth. Okay, fine. Liabilities means always outside liabilities. For these assets and liabilities, purchasing company is ready to pay 70 lakhs worth of the PC. Okay. Liquidation expenses incurred by the selling company 2 lakhs. Who will incur liquidation expenses? Who is going to liquidate? Selling company. Preference shareholders of selling company will get preference shares of the purchasing company. So this is the small information given. Now I should need to close the books of accounts in the selling company. That is my objective. Now, first of all these assets and liabilities as well as the equity components, they are placed under their respective ledgers. They are having books of accounts means what is the primary book of account, which is nothing but general ledger, right? Fine. So let me consider one particular asset for your understanding, which is plant and machinery. So let me open here. For example, just you can imagine plant and machinery account is there. Now tell me guys, plant and machinery, how much value is there? 20 lakhs. Asset is having debit balance, right? So two balance brought down. 20 lakhs. So similarly, you can consider one liability. You can take any liability. Let us take the trade payables. So trade payables having credit balance or debit balance? Credit balance. By balance brought down. How much value it have? 10 lakhs. Right. Now, we are closing our books of accounts means we are selling our business to the purchasing company. Whenever we are selling something to the other entity, in generally, what is the journal entry, guys? Not only the assets and liabilities I'm talking. In case, in generally, a particular asset you are going to sell in your organization, then what is the journal entry? That is the other entity. The other entity is nothing but debtor, right? So here the other entity is purchasing company, right? The other entity is purchasing company. That is purchasing company account debtor to asset account you will record, right? If you are selling a individual asset, but right now you are not selling an individual asset, you are selling group of assets as well as group of liabilities. That's why what I want to do, what are all the different assets taken over by the selling company, I will make it transfer to a specific account. That specific account popularly known as realization account. Sir, why you are transferring to the realization account? First, I want to show all the assets and liabilities worth which is taken over by the purchasing company at a specified account, realization account. If they are taking a single individual asset, then I'll directly go to that individual asset. I will record here by purchasing company, right? But they are not taken over an individual asset. They are taken over the group of assets. That's why first I want to make it transfer all the individual asset to this specific account, that is realization account. Sir, what do you mean by that, sir? Do you want to transfer this plant and machinery to realization? Yes, I want to make it transfer to realization first, which is 20 lakhs. Sir, do you want to transfer to trade payable to realization? Yes, to realization. Sir, if under plant and machinery, it is by realization, then here under realization to plant and machinery, 20 lakhs. Sir, under trade payable to realization, then under realization by trade payable, 10 lakhs. So the intention behind the transferring all these individual assets and all these individual liabilities to realization account is make it happen all the assets and liabilities in a single individual account. Then I can compare the purchase consideration which is going to be payable by purchasing company with this net worth, with this book value of the net worth. Then I can simply know the profit or loss due to closure of the my business, profit or loss due to sale of my business. Do you understand all of this point? So that's why as a primary step, what I should need to do, sir? I should need to do all the assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. The first step is all the assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. Guys, so just this is only for your understanding. So let me start the problem by opening a clear-cut realization. So let me open here realization account. You can tell me, guys, all of you, by seeing the problem, what are all different assets are taken over by the purchasing company? All the assets are taken over by the purchasing company except cash. All the outside liabilities also taken over by the purchasing company. So that's why what I'll record directly. So realization to sundry assets. Actually, you should need to record the individual assets. Just to save my time, just I'm recording here to sundry assets. Except cash, remaining all assets are taken over means. So total worth of assets here I given as 100 lakhs. 100 lakhs minus 5 lakhs means 95 lakhs. So 95 lakhs taken over means transfer to realization. Similarly, here I'll put by sundry liabilities. Same na realization under assets, we should need to record under debit side. Liabilities, we should need to record under credit side. I told you the background reason. So just I'm doing all the liabilities now. Just I'm doing for all the liabilities. So liabilities, can you please let me know the total amount? 20 lakhs plus 10 lakhs. How much, guys? 30 lakhs. Sir, you may have one doubt. What about this cash share then? This cash is not taken over by the purchasing company now. And cash is still available with me only. Then if cash is available with you, in your ledger balance, cash will be there. That is 2 balance brought down. Cash is still with me only. How much cash is there? Which is 5 lakhs cash is there. Sir, till now you discussed about assets and liabilities, sir. What about the equity component? Sir, equity component is nothing but our real owners' contributions. Ultimately, I should need to make it settle to our real owners. In case of liquidation, what happen in generally? What are the resources available to distribute among the shareholders? Simply, I should need to distribute. So that's why still those ledger accounts also exist in my books of accounts. Those ledger accounts means I have two different types of shareholders. One is equity shareholder, another one is preference shareholder. You can open equity shareholders account. You can also open preference shareholders account. This is equity shareholders account. This is preference shareholders account. Now, preference share capital belongs to preference shareholders account. That means whatever the balance exists under preference share capital, simply you can transfer to preference shareholders. That is by preference share capital account. Right? Entry preference share capital to preference shareholders account. So that's why I credited. How much amount, guys? 20 lakhs. Okay. Sir, then what about equity share capital, sir? Equity share capital belongs to equity shareholders account. So that's why equity shareholders by equity share capital. How much? 30 lakhs. Now tell me equity over preference over reserves and surplus. Guys, reserves and surplus belongs to preference shareholders or equity shareholders. Who is the real owners of the company? Equity shareholders or preference shareholders? Equity shareholders. That's why these reserves and surplus belongs to equity shareholders. Whatever the balance exists under security premium general reserve P&L account, that is credit balance or debit balance, it doesn't matter. It belongs to equity shareholders. So that's why you can also transfer securities premium, general reserve, P&L also to equity shareholders. So security premium is 3 lakhs. General reserve is for 2 lakhs. And P&L is for 15 lakhs, right? Now, if you check, all the individual components of the balance sheet were transferred in their respective accounts. So in closure of books of accounts of the selling company, step number 1 is dismantling of the balance sheet. Dismantling of the balance sheet means assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. If any asset or liability which is not taken over by the purchasing company, you should need to separately open in their specific ledger. For which purpose? Later on, we will resell to the other persons. Purchasing company is not ready to take over. We will sell in the general market. For example, cash was already realized asset. No need to sell anywhere. For example, here it is clearly given that, sir, plant and machinery was not taken over by purchasing company. Let us assume. This point was given. Then what I should need to do? Plant and machinery, I should need to separately open a separate ledger. For which purpose? I will sell in the outside market if purchasing company is not ready to take over. If I will sell, then how much proceeds I will get with that plant and machinery account will be closed. Do you understand? So that's the reason why if any asset or liability which is not taken over by the purchasing company, I will open it separately. I will realize it in the outside market at later point of time. Next, the shareholders contribution amount belongs to the preference shareholders. Just I'll make it transfer to preference shareholders account. Amount related to the equity shareholders account, I will make it transfer to equity shareholders account. Right? And one more important point I should need to mention here. 1 second, guys. Sir, this miscellaneous expenditure not written off, is it real asset? It is a fictitious asset, right? It is a fictitious assets. Purchasing company is ready to take over only real assets, not the fictitious asset. This miscellaneous expenditure not written off is also belongs to equity shareholders only. This is form part of equity only. That means the real worth of assets taken over by the purchasing company was 100 lakhs minus this cash 5 lakhs minus this 5 lakhs. Only 90 lakhs only taken over by the purchasing company. Here I mentioned actually 95, which is only 90 lakhs. Just for your understanding, now I'm making correction. So then what about this 5 lakhs, sir? This 5 lakhs also belongs to equity shareholders contribution. This 5 lakhs also belongs to equity shareholders worth. That's why I should need to make it transfer to equity shareholders account. If it is the reserve, positive reserve, I make it credited. If it is the negative balance or the debit balance, I should need to make it debited here. I mean equity shareholders account that are two miscellaneous expenditure not written off. That is 5 lakhs. Do you understand? Guys, is it clear? Anyone having any doubt in this? Just let me know at this stage. So many messages. I not yet check. Just let me check. Sir, but where are you, man? I am in the books of selling company. In yesterday class, I clearly mentioned type of amalgamation is irrelevant in the books of selling company. Just ignore. We are in the books of selling company. AS 14 doesn't applicable in the books of selling company. Whether the amalgamation in the nature of purchase, whether the amalgamation in the nature of merger, the same accounting procedure we are going to adopt. Okay. Next. Yes. Next, revaluation reserve is also transferred to equity shareholders, sir. Any reserves and surplus, ma. It is not revaluation and all other stuff. Whatever the balance belongs to the equity shareholders and preference shareholders, it will simply make a transfer to equity shareholders account. Sir, fictitious is also transferred to realization account, sir. Now I make it change, right? Okay. Just to understand that fact only, initially I transfer to realization, but fictitious asset will not transfer to realization account. Fictitious asset is not an asset. That asset is not taken over by the purchasing company. That belongs to the equity shareholders. Okay, fine. Sir, step number one over. Dismantling of balance sheet is the step number one. Just let me put the steps as well. So initially I not told, but in generally I will complete the entire accounting treatment in the books of the selling company in 5 steps, guys. 5-step approach. 5-step approach. Out of that, first step is dismantling of balance sheet. Second step is PC due. Okay, I'll write each and every step as well. No worries. Already there in the PDF. So just please all of you follow my flow for the time being. Sir, step number one, dismantling of balance sheet is over. Step number two is PC due. Now, what is this purchase consideration due, sir? That is simply nothing but at the time of sale of business, which entry you are going to book. I'm going to book purchasing company account debtor, purchasing company account debtor. If I sell individual asset, I may record it as two asset, but I am selling my business. Business means assets and liabilities. Right now, my assets and liabilities are sitting in which account? Realization account. Right now, my assets and liabilities are sitting in which account? Realization account. Rather than crediting the assets and all other components, here I am crediting the realization account because I am not selling the individual assets and liabilities. I am selling the group of assets and liabilities. Such group of assets and liabilities are sitting under realization account. That's why I will credit the realization account. At which value, sir? At the rate of PC, purchase consideration. So that's the reason before providing the accounting treatment in the books of selling company itself, in the working notes, we should need to clearly complete the calculation of PC itself because we should need to record the PC in this particular journal entry. Do you understand? Now tell me guys, here purchasing company account data to realization, PC was already given in the problem or not? PC was already directly given, which is 70 lakhs. So you can directly give 70 lakhs, 70 lakhs. Now give the entry impact in the ledgers. Sir, purchasing company, do you open? Purchasing company, do you open? You not yet open. You can open the purchasing company now. Then, sir, let me open the purchasing company. Here I'll open purchasing company account. Another ledger. So post that entry. Entry is purchasing company account at R2. Realization account. How much, guys? 70 lakhs. In purchasing company, this is to realization. Then in realization by purchasing company, 70 lakhs. This is step number 2, PC due. Sir, after due entry, what we should need to do, sir? We should need to receive the PC from the purchasing company. If you record the entry debtor to sales, then what you will do at later point of time, you will receive amount from the debtor. At the time of receipt of amount from the debtor, what is the entry? Bank to debtor you will record, right? Here bank to purchasing company, right? Sir, from purchasing company, you may receive equity shares of that company. You may receive preference shares of that company, or you may receive debentures of that company, or you may receive bank balance or cash balance, whatever the case may be. That's when not only bank. So if you receive equity shares of purchasing company, you should need to debit equity shares of purchasing company account data. If you receive preference shares of purchasing company, preference shares of purchasing company account data. If you receive debentures, debentures of purchasing company account data. Sir, if you receive cash or bank, cash of purchasing company, no need to write. Cash or bank for anyone is same. So that's why cash or bank account data. 2, you should need to cancel purchasing company to purchasing company. This is step number 3, which is PC receipt. Step number 2 is PC due. Step number 1 is dismantling of balance sheet. Are you with me, all of you, till now? Sir, then this entry posting we not yet done in the ledger. Now, if you check here, total we are receiving 70 lakhs, right? Out of this 70 lakhs, how much amount of cash we are receiving? How much amount of preference shares we are receiving? How much amount of equity shares we are receiving? Not clearly given, but in the problems they will clearly given. So here you can check total preference shares I am receiving 20 lakhs, because this is an example. I not provided each and everything here. So total preference shares I'm getting 20 lakhs. And 1 second, just give me a second. How it was recorded, we can know. Yeah, I'm giving the information here. 1 second. So this 70 lakhs, how I am getting now? 25 lakh, 30 lakh. So remaining is 15 lakhs. Fine. So this 15 lakhs is in the form of preference shares. This 25 lakhs is in the form of cash. This 30 lakhs in the form of equity shares. Now I'm giving the bifurcation as well. Now the PC we are going to receive from the purchasing company, right? How we are going to receive? 25 lakh worth in the form of cash, 30 lakhs worth of equity shares of purchasing company, 15 lakhs worth of preference shares of the purchasing company. Now, what is the exact entry here? Equity shares of purchasing company account data, that is 30 lakhs. Preference shares of purchasing company account data, that is 15 lakhs. Debentures we are not receiving. Cash we are getting. So cash, how much we are getting? 25 lakhs. So total 30 plus 15 plus 25. How much? 70 lakhs. We need to receive 70 lakhs. We received the 70 lakhs. Now you can give posting for this particular entry. Are you with me, guys? All of you. Now, in the purchasing company, buy equity shares of purchasing company. How much, guys, we received? 30 lakhs. Buy preference shares of purchasing company. How much we received? 15 lakhs. Buy cash account. How much we received? 25 lakhs. Now, in purchasing company, buy cash. Then in cash account, to purchasing company, 25 lakhs. Sir, buy equity shares of purchasing company means you should need to open another account, equity shares of purchasing company. Here, to purchasing company, 30 lakhs. Sir, buy preference shares of purchasing company means you should need to open another account, preference shares of purchasing company. That is to purchasing company. How much? 15 lakhs. Sir, nothing was made by me. Step number 1, dismantling of balance sheet I done. Step number 2, PC due entry passed and posted. Step number 3, just now I received the PC. Whenever I received the PC, just I make it posted in their respective accounts. Sir, after receipt of PC, what liquidator of the selling company will do? You know, at the time of liquidation, liquidator will be appointed, right? Now, once received the PC, what liquidator will do? Liquidator will realize remaining all other assets as well. Liquidator will realize remaining all other assets which are not taken over by the purchasing company. I told you earlier, if plant and machinery is not taken over by the purchasing company, which is left over in the selling company books, then at that point of time, liquidator will make it sell such plant and machinery. For example, let us assume plant and machinery not taken over by the purchasing company. Then what I should need to do? I should need to open the plant and machinery account. So it will show the debit balance 20 lakhs, to balance brought down. Now what liquidator will do? He will realize that in the outside market. Let us assume he sold that particular asset for 25 lakhs. Then what is the entry? Bank to plant and machinery, by bank, 25 lakhs. How much profit he earned? 5 lakhs profit he earned. In generally, profit at the time of sale of asset, we should need to make it transfer to P&L. But here P&L account was already transferred to equity shareholders account, right? So that's why for the time being, whatever the profit or loss you derived during the process of the closure of the business, you should need to make it transfer to realization account. Because the only one nominal account which is left over in my books of accounts is realization account. P&L account was already got transferred to equity shareholders account. You already transferred now. There is no P&L in your books of accounts. If you are transferring right now again one more time to the P&L, then P&L will have some balance. So that's why whatever the profit I derived here, again I will transfer to realization, which is 5 lakhs. So this transaction is not there in my problem. Just I'm telling you the various transactions are the various scenarios by taking this example. So that means what you are trying to tell here, sir. In step number 4, after receipt of PC, whatever the assets left over which are not taken over by the purchasing company, liquidator will realize in the outside market. If any profit or loss through that realization, it will be transferred to realization account. So then what about liabilities, sir? If any leftover liability is there, which is not taken over by the purchasing company, ultimately it will be settled by the liquidator. During this process also, if any profit or loss he derived, again, it should also need to be transferred to realization. So in step number 4, before distribution of PC among the shareholders, first he should need to check the leftover assets and leftover liabilities, and he should need to make it settle down. And during that process, any profit or loss he derived, he should need to make it transfer to realization account. That's what I want to highlight. Okay, anyway, here there is only one asset is left over by the purchasing company, which is cash, which is already in realized form. That's why no need to sell anything in the outside market. Do you agree? Okay. Sir, that's why there is no leftover asset or liability to realize in the outside market. Anyway, just we are having cash, just make it separate. Then what liquidator will do, sir? Liquidator will incur or will need to settle liabilities in a particular order actually. Not only liabilities, at the time of liquidation of the company, after getting realizations from all the assets, he will need to settle the payments in a particular order. What is that order? The order is, first he should need to start with liquidation expenses. Sir, what are such liquidation expenses, sir? Maybe the liquidator remuneration, maybe advertisement expenses for that particular sale, maybe commissions, maybe legal charges, all such stuff just I simply included under liquidation expenses. After that, he will make payment to security creditors. So liabilities which having the security, he will settle. In a particular order, he will settle. After that, unsecured creditors. After that, preference shareholders. After that, finally, equity shareholders. Now, during this process, if you check in the current problem, it is clearly given that liquidation expenses incurred by the selling company was 2 lakhs. Now, after getting the PC from the purchasing company and after realization of leftover assets, now from the balance, first I should need to incur liquidation expenses. Now, for the purpose of incurrence of the liquidation expenses by the selling company, what is the journal entry, sir? Now, can you please all of you tell me what is the journal entry for incurrence of any expense? Not only liquidation expenses, any expense. Expense to bank. Expense should need to be closed and transferred to P&L. But here P&L was already transferred to equity shareholders account. That's why whatever the nominal account coming to the picture, I will make it transfer to realization account. As I already told you, realization to expense. Now, if expense cancel to each other, then the net entry is realization to bank. Do you agree? For the purpose of incurrence of realization expenses by the selling company in their books, the entry is realization account at R2 bank. So realization account at R2 bank means in my ledger under realization, I should need to write to bank in bracket realization expenses. How much? 2000. Sir, in realization to bank, if it is, sorry, not 2000, 2 lakhs. 1 second, 2 lakhs. Sir, in realization, which is to bank, under cash account by realization, there is no difference between cash and bank here. So which is 2 lakhs. Sir, next in order, secured creditors, unsecured creditors, I should need to make it settle. If I check in the balance sheet, non-current liabilities are there, current liabilities are there. Both are taken over by whom? Purchasing company. That's why there is no leftover liability in my books of accounts. No need to settle down any secured creditor. No need to settle down any unsecured creditor. Next, in the order next, whom I should need to make it settle? Preference shareholder, I should need to make it settle. Now come to the preference shareholders. It is clearly given that preference shares of the selling company to the preference shareholder of the selling company, just they will receive preference shares of the purchasing company. Simply, preference shares of the purchasing company will ultimately issue to the preference shareholders of the selling company. Now, let me know in the form of PC, how much preference shares of purchasing company we received? 15 lakhs. In the entry, I clearly shown you, if you remember, preference shares of the purchasing company to the extent of 15 lakhs I received. Now this 15 lakhs to whom I should need to distribute among the preference shareholders. Where the preference shareholders account I have the preference shareholders account here. I have the preference shareholders account to the extent of 20 lakhs. But it is clearly given that whatever the preference shares issued by the purchasing company, those are belongs to preference shareholders. Now, if this asset given to this preference shareholders, then the entry is preference shareholders account data to preference shares of the purchasing company. Tell me, guys, if you are going to settle the preference shareholders in the form of cash, entry is preference shareholders to cash. Like that, you are going to settle the preference shareholders by issuing preference shares of the purchasing company, by giving preference shares of the purchasing company. That's why in preference shareholders account, to preference shares of purchasing company. How much value, guys? 15 lakhs. 15 lakhs. Sir, in preference shareholders to preference shares of purchasing company, then in preference shares of purchasing company by preference shareholders account, 15 lakhs. If you check with this account got closed. Now, if you come to the preference shareholders account, balance is there for 20 lakhs, but just we settled 15 lakhs. Sir, what about for other 5 lakhs? Loss to whom? Preference shareholders. Tell me, guys, which is loss to the preference shareholders. Any profit or loss derived during the closure of the business, again you should need to make it transfer to realization. So that's why here I should need to make it transfer to realization account 5 lakhs. In preference shareholders account, which is to realization, then in realization account by preference shareholders account 5 lakhs. With this, Preference shareholders account got closed. Now the one and only account which was left over is equity shareholders account. Coming to my liabilities part, and to settle this equity shareholders, what I have to settle this equity shareholders, I have cash and I have equity shares of the purchasing company. But before making final distribution, I told you not distribution in a particular order. Tell me guys, before making final settlement to the equity shareholders, first close the realization. Close the realization. Whatever the profit or loss derived through realization account, it should ultimately belongs to equity shareholders account, because who are the real owners of the company? Equity shareholders. Now through closure of the realization, the profit or loss, we can treat it as profit or loss due to sale of the business and profit or loss due to closure of the business as well. Because some of the assets you may sold out to the purchasing company, some of the assets you may sold out in the outside market. That's why whatever the profit or loss net balance you derived under the closure of realization account, you can treat it as profit or loss derived through closure of your business. Now let me close the realization account here. Can you please, all of you, let me know guys, the closing balance of realization account here? How much? Here this side 92 lakhs I am getting. This side around 105 lakhs I am getting. Here 105 you can consider. 92 minus 105. How much? 13 lakhs, huh? Tell me, yeah, no one is confirming. Please, anyone confirming through queries box? So which is belongs to equity shareholders account? 13 lakhs is the balancing figure. Under realization to equity shareholders, then in equity shareholders by realization, which is 13 lakhs. Now to distribute among the equity shareholders, I have only two resources. One is cash balance. How much cash balance I have? 25 plus 5, 30, 30 minus 2. 20, 30 minus 2, 28 lakhs worth of cash I have. Plus equity shares of the purchasing company. How much I have? 30 lakhs. So 30 lakhs plus 28 total, I have 58 lakhs to distribute among the equity shareholders account. Can you please check the equity shareholders account balance? Is it matching with 58 lakhs or not? Can we check? So all of you, can you please make the sum of the credit side first? 30 lakhs plus 3 lakhs plus 2 lakhs plus 15 lakhs plus 13 minus 5. 58 lakhs exactly. If you close the equity shareholders, or if you want to balance the for that 58 lakhs, I am paying in the form of cash 28 lakhs. In the form of equity shares of purchasing company, 30 lakhs. If the liquidator will distribute like this, then equity shareholders account got closed. Once you settle down the cash, then under cash by equity shareholders, 28 lakhs, then cash account got closed. If you are distributing the equity shares of the purchasing company, here by equity shareholders account, 30 lakhs, this was also closed. Now all accounts got closed. That is nothing but closure of the business. If you check one by one, realization account was already closed by transferring realization profit or loss to equity shareholders account. Cash account just now closed while distributing the balance to equity shareholders. Purchasing company, if you check, it was already closed. Next, come down. Equity shares of purchasing company. Now at the time of distribution to equity shareholders account got closed. Preference shares of purchasing company. So got closed. Preference shareholders accounts closed. Equity shareholders account closed. Sir, what is this magic, sir? All the accounts, how it got closed? That is the dual aspect concept. Double entry bookkeeping accounting. Once you settle down all the liability holders and all the equity part, then there will be no balance in your balance sheet. That's what I done right now. Is it okay, guys? All of you, is it fine? Do you understand the procedure? Anyone having any doubt? No need to bother. I will streamline everything. I will provide the clear-cut 5-step approach. Just if you blindly follow my approach, automatically your books of accounts will be closed. But that is not my intention. I want to make you like a blind. So you should need to understand the content of the concept, what really happening inside. That's what my intention. That's why at the first instance, I didn't clearly provide the steps as well. Just I explained the procedure and the accounting treatment, what happening internally. Okay. Sir, in the exams, how I should need to tackle, sir? Please, all of you, have a look here. Step number 1, I should need to start with this, which is dismantling of balance sheet. Dismantling of balance sheet. In case of dismantling of balance sheet, whatever the balance sheet given in the problem, I should need to dismantle. How I should need to dismantle? Assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. If any asset or liability which is not taken over by the purchasing company, you should need to open separate ledgers, because at later on the liquidator will be realize those under outside market, right? Next, preference share capital should need to be transferred to preference shareholders account. Equity share capital, reserves and surplus, any fixed assets are there, just to make it simply transferred to equity shareholders account. Dismantling of balance sheet is over. Come to step number 2. Come to step number 2. Step number 2. Before going to step number 2, go to the working notes. Before going to the step number 2, go to the working notes. In between, I am telling you what you should need to do. Go to the working note and calculate the PC. How to calculate the PC, which method of PC I should need to apply, everything we already discussed, right? So that's why under working note, you should need to apply the concept of AS14 and the method of PC. If it is net payments method, if it is net asset value method, if it is intrinsic value method, if it is lump sum method, how you should need to work out, you know already. Once the PC amount was fixed, then come to the step number 2. In step number 2, what you should need to do, you should need to record PC due entry. What is the PC due entry? Purchasing company account data to realization account at the rate of PC. Then come to step number 3. Step number 3 is PC receipt entry. Receipt. Sir, this PC you may receive in the form of cash, in the form of preference shares, in the form of equity shares, in the form of debentures as well. Once you received the amount, the entry is cash account data, preference shares of purchasing company account data, equity shares of purchasing company account data, debentures of purchasing company account data to purchasing company. This is step number 3, PC receipt. Then you can come to step number 4, PC distribution. PC distribution. Before going to distribute the PC, first what liquidator will do, any asset or liability which is not taken over by the purchasing company, first he will realize in the outside market. First he will go for assets. Which assets? Which assets he will go? Assets not taken over by the purchasing company. He will go. He will realize in the outside market. Any profit or loss, transfer to realization account. Then he will come to the liabilities in the order I told you. First, realization expenses, then secured creditor, then unsecured creditor, then preference shareholders, then equity shareholders. This is the distribution order. So at the time of incurrence of the realization expenses by the selling company, entry, realization to cash. We already discussed. Then while settling these liabilities, which are not taken over by the purchasing company, if any profit or loss again derived by the liquidator, he will transfer to realization account. Then he will come to the preference shareholders. During that process of settlement to preference shareholders also, if he derived any profit or loss, again transfer to realization account. Then before distributing to the equity shareholders, that means final settlement to the equity shareholders, before making final settlement to the equity shareholders, what liquidator will do? Liquidator will close the realization account, find the profit or loss. That profit or loss belongs to equity shareholders account. That's why Step number 5. Up in step number 4, up to distribution of equity shareholders or before distribution of equity shareholders, I'll complete. Step number 5, final settlement to equity shareholders. So before making final settlement, what I should need to do? Close the realization account, find the profit or loss, make a transfer to equity shareholders account. Then whatever the resources available with the liquidator, just he will make it distribute among the equity shareholders. If he have the resource of cash, he will distribute. If he have the resource of equity shares of purchasing company, he will distribute. Then those accounts will close. Equity shareholders account also got closed. These are the 5 steps we should need to follow for closure of the books of selling company. Guys, no need to write anything. All were clearly given. So stepwise clearly given. Okay. So no worries. In my notes or in my PDF copy also, all these 5 steps were clearly explained step by step. You will have very good content at the time of preparation, at the time of recollecting the things as well. Okay. Fine. So this is the process we should need to adopt to close the books of selling company. So let's go for a small and a quick break. Then post break, let's discuss accounting treatment in the books of purchasing company in both the methods, that is amalgamation in the nature of purchase as well as amalgamation in the nature of merger. So once done with that specific accounting treatments, then we'll discuss some special entries. Then we can able to move on to any particular problem. Okay. So definitely out of our 4 to 4.5 sessions for amalgamation, it took like 2 to 2.5 sessions exclusively to explain the theory. So my point is, if you are having the crystal clear conceptual clarity, you can resolve any problem without having any myths in your mind. That's what my intention is all about. Guys, please all of you assemble by 8:20. Then let's continue our journey. Yeah, welcome back, guys. So this second off, I purely dedicated for accounting treatment in the books of purchasing company. All of you, please concentrate. This is little bit technical. So once you people can understand, you can create magics here. So accounting treatment in the books of purchasing company. Now tell me one thing, is it AS14 is applicable or not? Applicable. That too, accounting treatment in the books of purchasing company is depending upon type of amalgamation, right? So there are two different types of amalgamations we've seen. One is amalgamation in the nature of purchase, and the other one is amalgamation in the nature of merger, right? You know already when amalgamation in the nature of purchase coming to the picture, when amalgamation in the nature of merger will be coming to the picture. If all such 5 conditions satisfied in the nature of merger, otherwise purchase. Sir, what is the method of accounting treatment we are going to adopt? Here it is purchase method, right? Here it is pooling of interest method. Now, first, let me discuss about this method, guys, all of you. So later on, let us check amalgamation in the nature of merger. First, let me discuss about the purchase method. Now, if you are going to purchase, all of you please steps into the shoes of the purchasing company. Please, all of you come out from the selling company. And one more thing, just before going to start with this, uh, so in the break, just I seen the doubts or the queries which were posted by the students. One of our friend just what he asked, sir, if at all goodwill is there in the balance sheet of the selling company, what I should need to do, sir? That depends whether goodwill is really taken over by the purchasing company. I mean, purchasing company is also assigning some value or the goodwill for that. Then you can transfer to realization account. If goodwill is not taken over by the purchasing company, you will separately open it. Then you may check. It may not be purchased by anyone. So that's why which is lost to the selling company. The entire amount of the goodwill you may transfer to the realization account. What I am talking, do you understand? If goodwill is directly taken over by the purchasing company, you will directly transfer to the realization account. Otherwise, you will open goodwill account separately, which is a loss. Through that, you can transfer to the realization account. If it is taken over by the purchasing company, goodwill will be debited, right? If it is not taken over by the purchasing company, then also goodwill will be debited only. Because if it is not taken over by the purchasing company, I will open it separately, goodwill account, to balance brought down. Then in realization account, the balancing figure will be by realization account. Tell me, guys. So that's the accounting treatment you can provide for any intangible assets, if at all it have their place in the balance sheet. Okay, just it is a clarification. Okay, fine. Welcome back, guys. Just let us concentrate the things on purchasing company for the time being. Still, if you are facing any problem or any issues with the selling company, we will discuss it later. So don't just mash up in between, because the flow is pretty much important to understand the things in the books of purchasing company. Now, let me know, guys, if you are purchasing any good or something, anything, what is the journal entry you may record in your books of accounts? If it is a credit purchase account data to creditor account, right? Creditor or supplier, whatever the case may be, from whom you are purchasing. Now, as a purchasing company, you are purchasing the business of the selling company. That's why here I'll record business purchase account rather than putting it as a purchase, which is a business purchase account. Business purchase account data to whom I should need to pay the money? Selling company. But right now, who is representing the selling company? Liquidator. Liquidator is appointed at the time of liquidation. That's why whom I should need to pay the money? Liquidator. The liquidator will collect money from purchasing company. He will distribute according to the norms. So that's why I should need to make money, or I should need to pay that PC to the liquidator of selling company. So I'm recording to liquidator of selling company account. Do you agree? So the first and foremost entry is simply purchase of the business as like purchase of goods. Purchase to creditor, which is business purchase account debtor to liquidator of selling company. Sir, how much amount I should need to make pay? At the rate of PC. So if they exclusively ask accounting treatment in the books of purchasing company, also you should need to calculate PC under working note. If they exclusively ask in the problem accounting treatment in the books of selling company, also you should need to know the PC. So that is the significance of the importance of the PC in the entire amalgamation. So no doubt about it, whenever they are asking any problem in amalgamation, just you should need to go to the working note. First, you should need to work out the PC. That's the reason I told you, if you made any, or if you committed any mistake in the PC, the entire problem will go into the different direction. Okay. So this is fine, sir. Now let us time being, let me give some figure, PC. In my earlier example, PC was almost 70 lakhs, right? So let me give the same thing. 70 lakhs is the PC. Okay. Next, entry number 2. Sir, you are purchasing the business means what you are really purchasing. I'm really purchasing assets and liabilities of the selling company. Then you should need to incorporate such assets and liabilities into your books of accounts or not. Because here, if you check, I purchased the various assets. Where it is? Sundry assets. Similarly, I purchased the various liabilities as well. But not this values. Not this values. I may purchase at book values. I may not purchase at book values. In generally, I will purchase those assets and liabilities at my agreed values. Such values will be clearly given in the problem itself. That's why first I should need to incorporate assets which were purchased by me. That is assets taken over, which are taken over. At the rate of which value I should need to incorporate? At the rate of agreed values I should need to incorporate. This is very, very important. Assets having debit balance, that's why I will debit those things. Okay, that is assets account debtor to liabilities which are taken over by me. I will make it credit because liabilities having credit balance. So which is also at the rate of agreed value. Which is also at the rate of agreed value. Now, once I incorporated the business assets and liabilities, I should need to nullify the business purchase account. So what I'm doing right now, I'm nullifying the business purchase account and I'm incorporating the assets and liabilities. So that's why business purchase is having the debit balance. To nullify that, I should need to make it credit. This is 70 lakhs. Now, this component is there, right? That is assets minus outside liabilities. Are assets taken over at the rate of agreed values minus liabilities taken over at the rate of agreed values. What we are in generally known, this component. This component we are known as NAV. Business purchase is there, right? This is at the rate of PC. Now in the second entry, what really we are doing, we are comparing PC with NAV. We are comparing purchase consideration with the NAV. PC means what we are paying, 70 lakhs. NAV means in what we are getting. In reply, what we are getting. Let us assume the real worth of the business, what we are taking over from the selling company was, let us assume 50 lakhs. Sir, you paid 70 lakhs, but the worth you are receiving was only 50 lakhs. Why you paid excess 20 lakhs, sir? The excess 20 lakhs is lost to your organization. You know that. Why you paid the excess 20, sir? No, that is not loss for my organization. Why I paid the excess 20 lakhs? Now, that excess 20 lakhs is in the form of goodwill. That's why I paid. This type of goodwill only people are calling as purchased goodwill. Do you understand? So the excess amount of the PC paid over the NAV, we can put it as goodwill. Sir, do you mean that in this particular situation, you are going to incorporate 20 lakhs as goodwill here? Yes, why not? No, let me create the other situation. Sir, the net worth or the real worth of the selling company business, which was taken over by me, was not 50 lakhs, sir, which was 80 lakhs. Then which is the situation of PC less than NAV? I paid 70 lakhs, but in return, I'm getting 80 lakhs. So 10 lakhs is profit. Is it capital profit or revenue profit? Capital profit. Whenever you are receiving any capital profit, whenever you are realizing any capital profit, that should need to be transferred to capital reserve. So at that scenario, 70 minus 80, which is 10 lakhs, we can call it as capital reserve. Reserves having the credit balance, then you should need to make it credit. Capital reserve 10 lakhs. Either one of this component will be coming to the picture, either goodwill or capital reserve. Both will not come at a time. Sir, if PC is equal to NAV, what is the scenario? No goodwill, no capital reserve. Whatever you are paying, in return, the same thing you are getting. Do you understand? So that's why first entry we can call it as business purchase entry. Second entry we can call it as incorporation of assets and liabilities. At this stage itself, you should need to compare PC with NAV. If PC is equal to NAV, no goodwill, no capital reserve. If PC greater than NAV, goodwill. If PC less than NAV, capital reserve. All such components you should need to incorporate. Is it fine? Next, sir, what is my next step, sir? I should need to give the real settlement to the liquidator. That's it, right? I should need to pay amount to the liquidator. Now for that, you should need to pass the entry, that is, while making settlement to the liquidator, while making settlement to the supplier, supplier to cash. Here, liquidator of selling company account debtor, 70 lakhs. How you are paying is the matters. Is it only in the form of cash? It includes equity shares as well. It includes preference shares as well. It includes debentures as well. Yes, sir. Then if it is cash, to cash account. If you are issuing the equity shares, that is to equity share capital account. If you are issuing the preference shares, to preference share capital account. If this equity and preference shares are issued with premium, for example, issue price is 15, face value is 10, excess of 5 rupees. Always these should need to be created with face value only. The excess of 5 rupees, I should need to make it to securities premium. If I issue debentures, I may credit the debentures account. The debentures also may be issued with premium, may be issued at discount also. Shares may not be issued at discount, but debentures may be issued at discount. If these debentures are issued at discount, then put discount on issue of debentures also. If these debentures are issued at premium, credit the securities premium account. So like that, you should need to check what is the face value, what is the issue price, what is the mode of PC. Accordingly, you should need to pass this entry. This entry, we can call it as final settlement to liquidator. Final settlement to liquidator. So only these three main entries you should need to pass in the books of the purchasing company to provide the proper accounting treatment for this amalgamation. The first and foremost entry is business purchase account data to liquidator of selling company. Then assets at the rate of agreed value you should need to incorporate. Liabilities at the rate of agreed value you should need to incorporate, which is nothing but NAV. It should need to be compared with PC. That is, you should need to cancel the business purchase. If PC is greater than NAV, goodwill. If PC is less than NAV, capital reserve. Then once you incorporated the net goodwill or capital reserve, you should need to make the final settlement to the liquidator. That is, liquidator of selling company to cash, to equity share capital, to preference share capital, to securities premium, to debentures. If the debentures are issued at discount, debit the discount on issue of debentures. Is it fine, guys? Just let me know anyone having any doubt at this stage. uh, Swati, please provide those handwritten notes for revision, sir. Absolutely, ma. You are not in my first class, but I will not share at this stage. So once all sessions got completed, I'll definitely share that PDF. Okay, if I share right now itself, you're always looking about that PDF. That's the reason I'm not providing. Okay, I'll provide it at the end. Super, it's clear. Guys, at one last time, just I'm asking you, we already done like almost we are at the end of second session. Are you people are comfortable with my teaching style, level, flow, content, concept, everything is fine. Are you with me? I hope you are enjoying my sessions. Varsha, how we will calculate PC? Varsha, I think you are not in my first class. So entire PC computation we done in the session number 1 itself. Various methods I discussed, how to calculate PC also I explained. So we are yet to do problems on such things. Okay. Yes, sir. Everything is clear. Fine. 1 second, sir. Where is you provide your guys? Just let me know one thing. You people can found my main material on amalgamation, internal reconstruction, and the other topic, liquidation of companies. Main material and solution material. You guys found my material? Yes, right? Yeah, fine. So handwritten notes not yet uploaded. So, okay, I'll upload once the amalgamation chapter got completed. I will just upload amalgamation separately. Like that for topic wise, I'll upload for handwritten notes. Okay, fine. Let me continue the discussion. So till now, just we discussed things related to amalgamation in the nature of purchase only. Now let me give some background story for amalgamation in the nature of merger. Guys, in case of amalgamation in the nature of merger, now let me know if this is a selling company assets we have here, what you can call equity share capital we have, preference share capital we have, reserves and surplus we have, and liabilities also we have. This is a typical balance sheet of the selling company. This is purchasing company. Now in case of merger, purchasing company is ready to take over all the assets, all these assets, all these liabilities. That too, all these assets and liabilities at book value only. Tell me, guys. That means if purchasing company is ready to take over all the assets and liabilities at book value only, then at the time of incorporation of assets and liabilities in the books of purchasing company at agreed values at book values, there is no difference for the first entry, same entry, business purchase account to liquidator of selling company 70 lakhs. Sir, amount of PC is not depending upon method of amalgamation. I told you it is depending upon the method of PC. That's why amount of PC doesn't change. The same entry I'm going to pass, business purchase account data to liquidator of selling company. That's why I'm not explaining. I'm not hitting anything for first entry. The same entry, there is no difference. Coming to second entry, I should need to incorporate assets and liabilities. Now, such assets and liabilities, I should need to incorporate at book values, right? Sir, assets at the rate of book value, not at agreed value. Here, agreed value is equal to book value. Liabilities, also I should need to incorporate at book value. Now, I should need to compare PC with NAV, na? Sir, NAV means assets taken over at the rate of agreed value minus liabilities taken over at the rate of agreed value. Here, assets taken over at the rate of book value minus liabilities taken over at the rate of book value means assets minus liabilities means which is nothing but net worth. Because all the assets I will consider, all the liabilities I will consider, all the assets and liabilities also I will consider at book value only. Now, assets minus liabilities means that is NAV means which is nothing but net worth. Tell me, guys. No one is confirming me. Here, assets minus liabilities is nothing but net worth only. And one more thing, just I want to highlight here. In case of amalgamation in the nature of merger, purchasing company will take over not only assets and liabilities, purchasing company will take over reserves and surplus of the selling company as well. How it is possible, sir? Sir, can you please differentiate amalgamation in the nature of purchase and amalgamation in the nature of merger? Literal differentiation, not due to those conditions and all such things, are the conceptual differentiation. Simply, merger means it's like my sister company. It's my sister concern. My sister concern means there is no difference between selling company shareholders and my company shareholders. Both are same, more or less. Whatever the profits belongs to the selling company, such profits belongs to me only. Just selling company is an extension of my hand. That's it. That's why whatever the reserves and surplus exist in the books of selling company automatically belongs to purchasing company as well. But if you check amalgamation in the nature of purchase, purchasing company will take over assets and liabilities, but it doesn't take over any reserves and surplus. But in case of merger, these reserves and surplus will also taken over by the purchasing company. That means apart from these assets and liabilities, I should need to incorporate reserves and surplus as well. Now in the NAV, assets minus liabilities minus reserves and surplus means the remaining will be share capital only. Do you agree? That means to compare PC with NAV, or rather than comparing PC with NAV, I can directly compare PC with the share capital. Do you agree this? Because reserves and surplus are also taken over by purchasing company. Now the net worth means assets minus liabilities minus reserves and surplus means only equity share capital plus preference share capital. Then I should need to compare PC with share capital of the selling company. The NAV is nothing but share capital of the selling company only. Sir, what you are trying to tell here, sir? Now the same situation is going to arise if PC is greater than share capital of selling company. What is the situation? Sir, if the PC is less than the share capital of selling company, what is the situation? I should need to check. This is nothing but net worth of the selling company only. If PC is more, I'm paying excess. I'm paying excess. Then under purchase method, I told which is goodwill. But in case of amalgamation in the nature of merger as per pooling of interest method, there is no place for goodwill. Why, sir? AS 14 clearly told that in case of merger method, if any excess of PC paid by the purchasing company over and above the share capital of the selling company, the excess we should need to adjust, the excess we should need to nullify with free reserves. Free reserves. After taken over of reserves and surplus of the selling company. Or can you give some mathematical or figures for better understanding? I'll give, no worries. Let us assume the PC was 70 lakhs, the same PC. Let's continue. Here, selling company equity share capital, just you can consider it as 40 lakhs. Preference share capital, you can consider it as 10 lakhs. So 40 plus 10, how much? Which is 50 lakhs. So PC is 70 lakhs, which is greater than share capital of the selling company, 50 lakhs. So how much excess I paid? 20 lakhs excess I paid. As per purchase method, I will simply put it as goodwill. But here I may not treat it as goodwill. As per the provisions of AS 14, the excess of PC paid over and above the share capital of the selling company should be nullified with the free reserves. After takeover of these reserves and surplus, after taken over of these reserves and surplus by the purchasing company. Sir, what you are telling, sir? For example, after taken over of these reserves and surplus, let us assume before taking over in the purchasing company, I have P&L like 5 lakhs. I have general reserve like 3 lakhs. Selling company, in selling company reserves and surplus. In selling company reserves and surplus, I have different reserves and surplus. Like I have statutory reserve 15 lakhs. I have P&L for 10 lakhs. I have general reserve for like something like 15 lakhs. So these are the figures I have. Now, once I consider the reserves and surplus of the selling company, then purchasing company P&L 5 lakhs plus selling company P&L 10. Purchasing company general reserve 3 lakhs plus here 15 lakhs. Purchasing company statutory reserve nil 0 plus selling company statutory reserve. How much? Once again. Yeah. So statutory reserve how much? 15 lakhs. Now this is the reserves and surplus status after takeover of reserves and surplus of the selling company. This is 10 plus 5, 15 lakhs, 3 plus 15, 18 lakhs, 0 plus 15, 15 lakhs. Now, what AS 14 tells to us, the excess of PC paid over and above the share capital of the selling company should be nullified with free reserves. Should be nullified with free reserves means statutory reserve is not a free reserve. I cannot utilize the statutory reserve to nullify this 20 lakhs. I can utilize these two free reserves. Free reserves are nothing but those reserves which are freely available for distribution of dividend. P&L account is freely available. General reserve is freely available. That's why you can consider this 15 plus 18 lakhs to nullify this 20 lakhs, right? So then which one I can utilize first, sir? There is no particular order. There is no particular guidance given by AS 14 for this. You can utilize P&L first if you want. Yes, 15 lakhs I'll directly utilize, sir. Then still I required 5 lakhs. That 5 lakhs you can utilize the general reserve. Then while presenting the balance sheet, P&L will show nil. General reserve will show 18 minus 5, which is 13 lakhs. Because entire 15 lakhs nullified with 20 lakhs and still 5 lakhs I required. That 5 lakhs I utilize it from general reserve. Then general reserve I'll show it at 13 lakhs. Sir, this one we understand. Picture is clear. If the other scenario comes, other scenario means if PC is less than share capital of the selling company. PC what we are paying is 70 lakhs. Let us assume share capital of the selling company is 100 lakhs. If this is the scenario. Or you can change the PC. Why can't you change the share capital? Let us assume the share capital same 50 lakhs. So if the PC is like 30 lakhs or like 40 lakhs, whatever the case may be, then how you should need to tackle? Sir, I am paying very less amount, but I am getting the worth of 50 lakhs. So in case of purchase method, the same I treated as capital reserve, right? Here also you should need to treat as capital reserve. For this, there is no difference. Simply capital reserve 10 lakhs. The only difference between the merger method and purchase method coming to the picture, when the excess of PC exists for more than the share capital of the selling company, the excess of PC you should need to nullify with the free reserves after considering the reserves and surplus from the selling company. Except this, there is no difference between merger method and purchase method. And one more important fact, all the reserves and surplus of the selling company will become the reserves and surplus of the purchasing company in case of merger method. The reason is very simple. So in case of pooling of interest method, the name itself clearly tells to us pooling of interests. Pooling means adding of interests. What you should need to do, just to consider all the assets, just to consider all the liabilities, including reserves and surplus. All you should need to consider at book value. That's why this method, we can call it as pooling of interest method as well. Do you understand? Fine. So let me summarize the things for you guys. So third entry, again, there is no change. That's the reason why I'm not explaining one more time. The only change in the only second entry part. Okay. Okay. Anyway, let me summarize the things accounting treatment in the books of purchasing company, which are casual entries or the normal general entries. Towards the special entries, I not yet started any discussion. Okay. First, let me complete or let me summarize this. So basically in the books of purchasing company, accounting treatment is all depending upon the type of amalgamation. If the amalgamation is amalgamation in the nature of purchase, we are adopting the purchase method. If the amalgamation is amalgamation in the nature of merger, we may adopt the pooling of interest method. In case of purchase method, the first entry is as usual business purchase to liquidator of selling company at the rate of PC. In case of merger method also, the first entry is same, there is no difference. Second entry, we should need to incorporate assets and liabilities. In case of purchase method, all assets and liabilities we should need to incorporate at agreed values only. Now the assets at the rate of agreed value minus liabilities at the rate of agreed value, we can call it as NAV. This NAV we should need to compare with PC by nullifying the business purchase account. That is by crediting the business purchase account. Business purchase account is at PC value and net assets, that is assets minus liabilities, is at NAV value. Now you can compare PC with NAV. Excess of PC over NAV you can treat it as goodwill. Lower of PC over NAV you can treat it as capital reserve. Either the goodwill or capital reserve also you should need to incorporate at this stage. Then you can go for the final settlement to the liquidator of selling company to equity share capital, preference share capital, debentures, securities premium, or if have any discount on issue of debentures, you can debit that. Now, at the time of recording the second entry in case of merger, you should need to remember one thing. In case of pooling of interest method, we should need to incorporate all assets. We need to incorporate all liabilities. Along with that, we should need to incorporate reserves and surplus as well. But now we should need to check PC with directly share capital of the selling company, because here there is no difference between NAV and share capital of the selling company. We are considering all the assets and all the liabilities, including the reserves and surplus. That's why NAV is nothing but share capital. If PC is greater than the share capital of the selling company, the excess amount what we paid should need to be adjusted with the revenue reserves or free reserves after taken over of reserves and surplus from the selling company. No, sir, if the PC is less than the share capital of the selling company, the excess we should need to make it transfer to the capital reserve. All such adjustment or recognition of capital reserve should need to happen in second entry itself. Sir, do you mean that at the time of recording the second entry, assets are recorded book value, liabilities are recorded book value, reserves are recorded book value. In this reserves, if any free reserves are there, excess of PC over the share capital of the selling company, I should need to adjust at this stage. Yes, you can adjust at this stage itself. What I'm trying to telling, in this reserves, P&L is 10 lakhs is there, right? After taking this 10 lakhs, it is nullifying with excess of PC over with share capital. Then don't consider the P&L here. Because if you consider that, then again you should need to set off. Here, right? So that's why don't consider it. Similarly, general reserve, if I consider this 3 lakhs, it will be nullified, right? Because I required 5 lakhs. So this entire 3 lakhs will be nullified. Then don't consider here. So like that, whatever the excess of PC over the share capital of the selling company, you want to nullify that reserves and surplus, no need to recognize here. It will be nullified. No, sir. The other scenario, if PC is less than the share capital of the selling company, then apart from these reserves and surplus, you should need to incorporate the capital reserve as well. That point you should need to bear in your mind. But there is no place for goodwill in case of pooling of interest method. And the third entry is the as usual entry. Okay, let me check with doubt session. Okay, one of our student asked, it's very good question, sir. What if the free reserves are not sufficient, sir? Debit P&L. If free reserves are not sufficient, what I can do? I can debit the P&L. For example, there are no free reserves at all. 70 lakhs here, 50 lakhs here. Excess of PC over share capital of the selling company. Just give debit to the P&L. That's it. That is the only option I have. But don't debit it to the goodwill. Okay. Fine, guys. Anyone having any doubt? Guys, I know without having any particular problem, just we are rounding over the concepts. Still, if you are having any little bit of issues in your mind, all will be resolved at the time of explaining the problems as well. So just be patient, give some time to me. So once try to absorb the things in your mind, understand the things in your mind. So once those were captured by your mind, then once we're done with the problems, automatically stored. Everything will be clarified. Okay. Guys, shall I continue? So let's extend our discussion towards the special issues or the special aspects. If you're okay, if you're comfortable, then I'll start with that. Yeah. So now if you check, we done with PC meaning, types of PCs and accounting treatment in the books of selling company, and we're done with accounting treatment in the books of purchasing company as well. The major issues we've done. Now, what I'm discussing, things related to special issues. What are these special issues, sir? First, let me explain the special issues in purchasing company. Okay. This is only exclusively related to purchasing company accounting treatment. You know, there are two methods, that is in purchase method, and the other one is pooling of interest method. That is merger. Purchase, amalgamation in the nature of purchase, amalgamation in the nature of merger. Now the point is, in selling company books, one reserve is there, which is statutory reserve. Let us assume which is 15 lakhs. You know the meaning of statutory reserve. Statutory reserve is a specific reserve which should need to be maintained by that particular entity to comply the provisions of the statute. In that particular statute, it is clearly told it should need to be maintained. For example, in case of banking company, you might have listened. So each and every company should need to transfer certain profits to certain particular reserve. This is as per the act, which is a statutory reserve. Maybe those companies, as per FEMA Act, who are dealing with the exports and imports, they should need to make it transfer some amount to the foreign exchange translation reserve. Those are the statutory reserves. Now, due to the amalgamation, in case of purchase method, purchasing company is ready to take over the selling company. It will take over assets and liabilities, but it doesn't take over the reserves and surplus of the selling company. Do you agree? In case of merger, only the reserves and surplus of the selling company belongs to purchasing company. But in case of the purchase method, the reserves and surplus of the selling company will not become the reserves and surplus of the purchasing company. But to comply the statute, I should need to maintain this reserve, right? As per the statute, I need to maintain, but as per my method, I am not maintaining. Then what I should need to do, sir? To follow that particular provision, I should need to maintain the statutory reserve by giving the credit to statutory reserve account 15 lakhs. Sir, then debit to which component I should need to give? You should need to give the debit to one special account, which is amalgamation adjustment account, 15 lakhs. Sir, why you are giving debit to this particular account only? This 15 lakhs I need to maintain for some years. For example, I need to maintain for 5 years. Selling company already maintained 2 years. That means purchasing company should need to maintain 3 more years. Then once I maintained for 3 more years, then no need to maintain. Then later on, I will reverse that entry. That means for these 3 years, to maintain for these 3 years in the books of purchasing company, I'll record this entry first, amalgamation adjustment account at R to statutory reserve account 15 lakhs. Once 3 years got expired, then I'll reverse the entry. That means statutory reserve account at R 15 lakhs to amalgamation adjustment account, that is 15 lakhs. That's why this account we created only to adjust the statutory reserve. Later on, I will reverse that. Later on, I'm going to reverse that. There is no specific significance with this account. I'm not doing anything with this in my books. Just to maintain the statutory reserve as a process of adjustment in amalgamation, just I'm recording. That's why I told it as amalgamation adjustment account. Once the time period got expired, I will make it reverse. Then, while showing the balance sheet under reserves and surplus, post amalgamation, both the components I should need to show under reserves and surplus only. Amalgamation adjustment account, I will show it as negative figures. Statutory reserve, I will show it as a positive figures. The impact will be nil. Due to maintenance of statutory reserve of the selling company in the books of purchasing company, the balance sheet impact is nil. Under the reserves and surplus, amalgamation adjustment account shown as negative figures, statutory reserve shown as positive figures. That's why there is no impact. Do you understand? Sir, in case of pooling of interest method, if the same story is there, then how I should need to adjust? No need to do anything. because all the reserves and surplus of the selling company will automatically become the reserves and surplus of the purchasing company in case of merger. Tell me, guys. We are telling that clearly in case of merger, the reserves and surplus, apart from assets and liabilities of the selling company, we should need to incorporate the reserves and surplus of the selling company as well. Under such reserves and surplus, statutory reserve is one of the reserve. And that too, we are not touching the statutory reserve to nullifying the excess of PC over share capital of the selling company as well. We will touch the revenue reserves. We will touch the free reserves only. That's why statutory reserves are doesn't intact. Statutory reserves are not intact. The same statutory reserve will be there in the books of purchasing company. That's why no need to maintain any amalgamation adjustment account in case of amalgamation in the nature of merger. Are you clear this point, all of you? Tell me, guys, are you clear with this, all of you? Are you clear? Can you please confirm anyone? This concept. Yes, fine. Yeah, 1 second. Varsha. Varsha is asking another question. What she's asking, as per your explanation, NAV system, you are telling that NAV is calculated as assets minus liabilities will be the PC. Then it will be same. How you will compare it? My dear Varsha, PC method means not only, I thought it's what I understood. You are not attending my class 1. Okay. So the PC may be under different methods. PC may be under net payments method, under net asset value method, under lump sum method, or let me give here intrinsic value method or lump sum method. For example, if the PC is under net payments, if I comparing PC with NAV, definitely there is a chance of occurring difference between PC and NAV. If the PC is under itself is NAV method, then if you compare NAV with NAV, this itself is PC, this is NAV, then there is no goodwill or capital reserve in this situation. If the PC is under intrinsic value method, again, which is NAV, maybe at this stage there is no difference. If the PC is under lump sum method, if you compare PC with NAV, again there may be a chance of occurring difference. And one more important thing I want to highlight you. PC, no need to record at issue price. Even though the PC is under NAV method or intrinsic value method, if the entity want to record PC at their par value, then this PC, this NAV or intrinsic value is at par value, then par value is different from the real NAV, then at this stage also there may be a chance of occurring difference between PC and the NAV. Do you understand my point, guys? So what held out is, sir, you are telling that in the second entry we should need to compare PC with NAV na, to know the goodwill or capital reserve in case of purchase method, or in case of merger method, excess of PC over share capital, right? Or the lower of PC over the share capital. How we generally say in NAV are different. Both are same na. That's held out. First, you should need to understand one thing. The method of PCs are quite different, not only NAV, other methods of PC are available. If you are adopted the other methods, definitely there is a difference between PC and NAV. No, sir. If you are adopting still NAV or intrinsic value method, still there may be a chance of occurring difference between PC and NAV. The reason is, if they are following the NAV method, let us assume, but PC is recorded par value, then PC value is different, then real NAV value is different. Still there is a chance of occurring difference. So these are very sensitive points, guys. Hope you are sensing it. Hope you are understanding it. Yeah. It's fine. Fine. Next. Anyway, Varsha, you asked one good question. With that extension, there are 2 to 3 more special items, but just let me take U-turn. I want to try to explain one more important fact. Okay, what is that? I'll tell you. So many students asked at that moment, sir, you told that PC may be recorded at issue price and PC may be recorded at par value. So many students feel that, sir, PC is recorded at issue price only, correct, sir. Par value means PC is not representing at their original value now. I told you, if you really remember in the yesterday's class, I will explain this at the time of right movement. If you are following to record the PC at issue price, if you are following to record PC at par value, it doesn't make any difference. Just now, I want to prove that. So right now, just I want to prove that. So please, all of you concentrate here. Let me take some quantum figures for proving this. Let us assume number of shares issued as PC, number of shares, 1 lakh shares at the rate of 15 rupees is the issue price. So total PC is 15 lakhs. This is PC, total PC is 15 lakhs. And let's take NAV is, can consider something like that 12 lakhs. Okay. So you can consider NAV as 12 lakhs. Or you can consider 8 lakhs. That's a better thing for me. Okay. NAV is 8 lakhs. Now tell me, guys, all of you, if I compare PC with NAV. So PC with NAV means first entry, as usual entry, business purchase to liquidator. That is 15 lakhs, 15 lakhs I should need to record. Number 2, assets, liabilities, business purchase. So business purchase is at the rate of PC, which is at 15 lakhs. This is nothing but NAV. This is at 8 lakhs. Sir, PC is greater than NAV. So that's why, which is the goodwill situation. So goodwill I should need to incorporate for 7 lakhs. Goodwill is for 7 lakhs. Next, the third entry is liquidator final settlement, liquidator to equity share capital to securities premium. 15 lakhs. Sir, now share capital should need to be credited with face value. 15 rupees is the issue price. Face value will be the 10 rupees. Let us assume 1 lakh into 10, which is 10 lakhs. The excess 5 lakhs you can credit it to securities premium. 1 second. So which is securities premium. Okay. So now come to the second situation. What is that second situation? PC is recorded at par value. If I record PC at par value, PC is nothing but number of shares issued as PC 1 lakh into 10 rupees, which is 10 lakhs. NAV is how much? 8 lakhs. Now let me record the same entries if I record PC at par value. Business purchase to liquidator at the rate of PC, 10 lakh. Second entry, assets I should need to incorporate, liabilities I should need to incorporate at the agreed values, that is assets, liabilities. This is nothing but NAV. NAV is 8 lakhs. To business purchase, now business purchase is at 10 lakhs. Now if I compare PC with NAV, excess of PC over NAV is only 2 lakhs. That's why I want to incorporate goodwill only for, here under assets I need to incorporate, right? So goodwill is only 2 lakhs. In earlier case, goodwill is 7 lakhs, but right now I'm getting goodwill as only 2 lakhs. Okay. Let me complete the third entry as well. Third entry, what is the third entry? Liquidator. How much I should need to pay? 10 lakhs to equity share capital. To equity share capital is 10 lakhs. Guys, just give me a second, please. 1 second. Right. Thank you, guys. So liquidator of selling company account at R2, equity share capital 10 lakhs. Because right now here, I'm not issuing equity shares at issue price. I'm issuing equity shares at face value itself, right? That's why there is no securities premium. Now my point is, if you are recording PC at issue price or if you are recording PC at par value, both the impacts are same. You know how it will happen? Please consider it, all of you. Sir, in the first scenario, goodwill was 7 lakhs. Security premium is 5 lakhs. Goodwill is capital loss. Securities premium is like capital profit, like which is reserve capital, like a capital type of reserves. So the net impact is like the reserves and surplus. Net impact is net goodwill is 2 lakhs. Net goodwill impact is 2 lakhs. Now, in this case, you only incorporated the goodwill 2 lakhs. There is no securities premium. That's why here also net impact of goodwill is 2 lakhs. So that's the reason I'm telling you, if you record the PC is at issue price, if you record the PC is at par value, it doesn't make any difference in accounting point of view. Hope you realize such fact at least right now. Tell me, guys. Manisha. Manisha is asking one doubt. Sir, amalgamation adjustment account will be shown where? Manisha, you should need to follow my flow. I already told you, na. So amalgamation adjustment account need to show under reserves and surplus as a negative figure. Statutory reserve will show as a positive figure. Both will nullify to each other under reserves and surplus account itself. Both should need to show under reserves and surplus. Okay. Yeah, that's fine, guys. Let me continue the special issues discussion. Just I completed only one special issue, which is related to statutory reserve maintenance through amalgamation adjustment account in under purchase method, and no need to provide any amalgamation adjustment account in pooling of interest method. That point I explained. Then after that, just I taken one case to proving recording of PC at par value and issue price, both the impacts are same. Now let me take the second special issue. The second special issue is related to intercompany owings. So what is this intercompany owings? Sir, this is selling company, let us assume. This is purchasing company. Purchasing company usually sell goods to the selling company. This is not by virtue of amalgamation. Before amalgamation itself, there is some seller-buyer relationship in between purchasing company and selling company. Or maybe selling company is like a end manufacturer of the finished good, and the raw material is going to be produced by the purchasing company. Ultimately, purchasing company is going to sell such raw material to the selling company. So something like that. So later on, they are want to go for the amalgamation. So why can't two different entities? So then raw material and finished goods will be done by a single entity. That's maybe the thought process, something like that. Sir, as usually, whenever purchasing company is selling goods to the selling company, purchasing company will add 10% profit. Let us assume purchasing company is selling goods for the cost worth 1 lakh. Now it add the profit 10%. At the rate of 10% means 10,000. So total selling price is coming to the picture 1.1 lakh. That is 1 lakh 10,000. Now all are going to occur on credit basis, let us assume. Then in purchasing company books, what is the entry, guys? At the time of sale of goods, selling company to sales. Selling company is a debtor. Selling company is a debtor means under asset side, selling company, under debtor side, selling company will be there with 1,10,000. Then in selling company, it's treated as a credit purchase of goods. Then the entry is purchases account debtor to creditor or the supplier account. That is supplier or the purchasing company is a liability. So under creditors, it will record purchasing company for 1,10,000. Now, whether the amalgamation is in the nature of merger, whether the amalgamation in the nature of purchase, just you can leave over. If purchasing company wants to take over the assets and liabilities of the selling company means, including this particular creditor will be taken over by the purchasing company. Once purchasing company taken over, it will be incorporate here. Creditors, purchasing company 1,10,000. Now tell me, guys, is it meaningful to record a liability in the books of purchasing company which is payable to the purchasing company? Is it meaningful to record a particular liability which should need to be payable to the purchasing company by the purchasing company? It's completely meaningless. So that's why whatever the creditors exist, it should need to nullify with the debtors. Anyway, debtors, whether you can able to ask money from the selling company right now, once the selling company liquidated, then there is no one is there to ask money from the selling company. That's why you are unable to realize the money from the debtor and no need to pay money to the creditor as well because you only the creditor. That's why you should need to nullify this creditors with the debtors by passing the entry that is creditors account debtor to debtors account. So if I want to make it record in like a little bit technical manner, the entry is trade payable account debtor to trade receivable account. So elimination of intercompany owings. This is known as elimination of intercompany owings is the entry is trade payables account debtor to trade receivables. Sir, similarly, maybe bills receivable, bills payable concept is there. Bills payable to bills receivable. Maybe similarly, loan receivable, loan payable may be there. Loan payable account debtor to loan receivable account. The same concept you may extend for sale of goods or bills receivable or maybe loaning related transaction or financing related transaction. Hope you understand. Anyone having any doubt on this intercompany owings? Just let me know. It's clear, right? Okay, guys. Let me go to the third special item. Okay, third special item. Fine. What is that? Just let me rub this. 1 second. Because I required some other content, so that's why just I'm rubbing. Okay, fine. Now concentrate. So which is third aspect? What is that aspect? First, I will let you know. Purchasing company is selling goods to the selling company ultimately, right? By adding 10% profit. Now, in selling company, closing stock, let us assume 50,000 worth of goods are there. Now, how this closing stock derived by the selling company? Selling company purchased goods from the purchasing company. Out of it, some of the goods were sold out. Some of the goods means out of this 1,10,000, 60,000 worth of goods, 60,000 cost for the selling company goods were sold out. Remaining 50,000 worth of the goods are still there in the closing stock. Similarly, purchasing company having their own closing stock. Purchasing company is having their own closing stock. It's almost like purchasing company having their own closing stock at 1 lakh, let us assume. It have their own production, it have their closing stock. Now purchasing company closing stock at the rate of 100. In the process of amalgamation, purchasing company will take over all the assets as well as liabilities, including this closing stock. Now, closing stock, which is taken over from selling company, also I'm including here, which is 50 lakhs, but which is at the rate of 110 for me. Why, sir? I'm selling at the rate of by adding 10% profit. If 100 rupees is the cost, then 10 rupees is the profit. Now tell me, guys, as per AS2, should I need to adopt the uniform accounting policy? Different accounting policies now. One closing stock can I measure at cost, another closing stock can I measure at market value? That doesn't correct. That too, it is clearly said in AS2, inventory should need to be valued at cost or NRV, whichever is lower. My cost price is 100, my NRV is 110. Then whichever is lower means I should need to record at 100 only. But why you are recording at 110? That's wrong, correct? Out of this 110, 10 rupees I should need to remove to show such closing stock at cost or NRV, whichever is lower. To show this closing stock at cost price, I should need to remove 10 rupees. Sir, for 110 rupees, 10 rupees is the unrealized profit lying in the closing stock. Then on for 50, so it's not 50 lakh, it's 50,000. Then on 50,000, how much will be the unrealized profit? That is 50,000 multiplied with 10 by 110. How much, guys? 50,000 multiplied with 10 by 110, which is equal to 4545. Sir, now what you want to do, sir? I want to decrease the closing stock. Closing stock is an asset. If you want to increase, it should need to be debited. If you want to decrease, it should need to be created. One aspect is to closing stock account, that is 4545. What is the other aspect? Sir, unnecessarily you increased the closing stock, right? Now, due to which your profits got increased. Now you should need to decrease such closing stock. If that is the case, in generally, you should need to debit the P&L account. The entry is P&L account at R2 closing stock account. But this is not the aspect you should need to debit in case of amalgamation. Why? Why this was occurred actually? This was occurred during the process of amalgamation, right? You know the closing stock value is not 50,000. You know the closing stock value is less than 50,000, but still you acquired the closing stock at 50,000. The excess value at which you are acquired is nothing but goodwill. That's why you should need to debit the goodwill account. Do you understand? No, sir. I want to make it debit with the capital reserve. Yes, if you want to make it debit with the capital reserve, you can use the capital reserve. There is no difference for me. Because if you want to debit with the goodwill, later on, if you want, you can make it set off the capital reserve balance with the goodwill account as well. That's why what I want to try to tell here, in the second entry, if excess of goodwill over NAV is coming to the picture, then in the second entry, goodwill is there, you can directly give goodwill here. No. In the second entry, capital reserve was exists, sir. Then don't give goodwill here, because again, if you give the goodwill, you can able to set off such goodwill with the second entry capital reserve. Then at that point of time, it is better to directly debit the capital reserve. Do you understand what I'm trying to telling here? In the second entry, PC you are comparing with NAV, na? If PC is greater than NAV, goodwill, na? Then you can directly give goodwill here. No. The scenario is PC less than NAV, sir. Here I got the capital reserve. Then if you first give the goodwill, again this goodwill should need to be knocked off with the capital reserve, na? Then again this goodwill balance will be nil. You are debiting the capital reserve only. Rather than providing the goodwill debit, again cancelling, you can directly just debiting the capital reserve. But under the closing stock, with which name you should need to credit, the name is stock reserve. The name is stock reserve, because we are decreasing this with the name of the stock reserve. So the ultimate entry is goodwill or capital reserve to stock reserve account, which is known as elimination of unrealized profit lying in closing stock. The special adjustment is elimination of unrealized profit lying in closing stock. The entry is goodwill or capital reserve to stock reserve is the entry. You know, capital reserve account we should need to reduce from the reserves and surplus. Stock reserve amount we should need to make it reduce from the closing stock while representing under current assets in the balance sheet. These are the adjustment you should need to make at the time of preparation of balance sheet as well. That's it, guys. These are the special issue. One more special issue is there. I'll explain once. If you are comfortable with this, just let me know. Let me check the query box. Anyone having any doubts? Sir, in intercompany owings, the treatment is similar if the selling company is the creditor of the purchasing company, sir. Absolutely. Why not? Yes. Your answer is absolutely fine. Earlier I told purchasing company is having debtor, selling company is acting as a creditor. The concept is holds good if the selling company sold goods to the purchasing company, right? Fine. So hope the stock reserve concept is also clear. If it is okay, let me take the last or the final special issue for this session. With this, I can able to complete the 100% theoretical concept or a theory related to the amalgamation. Then we can simply start the problems from the next session onwards. Okay, just spare 5 more minutes. It will be completed the entire theory. So which is related to the last special issue is related to liquidation expenses. Liquidation, or sometimes we can call it as realization expenses, whatever the case may be. Accounting treatment for liquidation expenses is the concept. Sir, this impact liquidation expenses impact will be there both in the books of purchasing company and selling company. That's why I will try to explain simultaneously in both the books. Concentrate. The first scenario is liquidation expenses incurred and paid by selling company. In general, liquidation expenses belongs to selling company, incurred by selling company, paid by selling company. Second scenario, first paid by purchasing company and later on, no, first paid by, sorry, one second. First paid by selling company and later on reimbursed by purchasing company. Last scenario, incurred and paid by purchasing company. I'll tell you these cases. Sir, in general, liquidation expenses belongs to selling company. So that's why in the first case, incurred and paid by the selling company. In the amalgamation terms and conditions, what is the one of the condition is? Like just I'm telling the scenario. First, what are the liquidation expenses belongs to selling company? It should need to be incurred out of their pockets. Later on, if selling company inform the same information to the purchasing company, to the extent purchasing company will reimburse. That is the second scenario. So the third scenario is liquidation expenses not at all relevant or not at all checking by the selling company, ultimately incurred and paid by the purchasing company itself. That is the agreement. These are three different scenarios. In the first scenario, incurred and paid by the selling company, then what is the accounting treatment in the books of selling company? What is the accounting treatment in the books of purchasing company? Now tell me, what is the accounting treatment in the books of selling company, guys? Whenever I'm incurring expenditure at the time of closure of my books of accounts, entry expense to cash, then expense should need to be closed and transferred to realization, then realization to expense, then the net entry is realization to cash. This type of entry we already seen in my example. Realization to cash. Tell me, guys, this entry we done earlier. I'll show you. Just give a moment. We wrote this entry in the books of selling company. I'm talking. Where my entries? Somewhere I written. Okay, it's a little bit clumsy. Yeah. Here he wrote expense to bank, realization to expense, expense nullify, then realization to bank or cash. Here it is there. So the same fact I'm continuing here. So just I'm telling, if such liquidation expenses were incurred and paid by the selling company, then the entry in the books of selling company is realization to cash or realization to bank. Then at that moment in the books of purchasing company, no entry, no impact for me. What is the impact? If selling company expenses incurred by the selling company, it's not my transaction at all. This is not my cup of tea. No entry in my books. Now, if you come to the second scenario, liquidation expenses initially incurred and paid by me. Later on, those will be reimbursed by purchasing company. That means these are not your real expenses. You are incurring right now, but again reimbursing means these are not your expenses. That means if you are paying, then cash will be out. But these should need to be recovered from whom? Purchasing company. That's why you should need to debit the purchasing company. So entry is purchasing company accounted to cash. Later on, if the purchasing company reimburse the amount, then you will get the money, right? Bank or cash to purchasing company. This should happen at two different time intervals. Purchasing company to cash at the time of payment. At the time of reimbursement of those expenses by purchasing company, you are receiving such cash, that is bank or cash to purchasing company. Do you agree? Now, sir, what about the scenario in the books of purchasing company, sir? Whenever it is reimbursing means cash outlay is there to cash. why you are paying to the selling company. You know the worth of the business of the selling company. You committed to pay this excess amount, right? Whenever I am committed to pay excess, goodwill accounted are to cash. No, sir, in the second entry, while comparing PC with NAV, I am deriving the capital reserve. Rather than giving the debit to the goodwill directly, you can give debit to the capital reserve. How you given here? Goodwill or capital reserve. So similarly, you can just provide goodwill or capital reserve. Goodwill or capital reserve accounted are to cash. Now coming to the last scenario, incurred and paid by the purchasing company. What is the problem in the books of selling company? No entry. No need to pay, no need to incur. Purchasing company will incur and it will pay. Purchasing company will pay means again the same entry you should need to repeat here. Goodwill or capital reserve to cash. Hope you understand this. Guys, in the notes, everything was I mentioned, including this particular chart as well. But don't be confused. They are incorporating all these points in the problems as a one typical adjustment. If the liquidation expenses incurred and paid by the selling company in the books of selling company, realization to cash in the books of purchasing company, no entry. First paid by the selling company, later on reimbursed by the purchasing company in the books of selling company, purchasing company to cash. At later on reimbursement means bank to purchasing company. In the books of purchasing company, goodwill or capital reserve to cash. Incurred and paid by the purchasing company, then in the books of selling company, no entry. In the books of purchasing company, the same entry should need to be continued. That is goodwill or capital reserve to cash. That's it, guys. This is for the day. So I think so tomorrow we will not have any session. So day after tomorrow, let me start with problems. So please revise the content till now from top to bottom what I have explained. So in the next session, first what I will do, I will provide mind map from top to bottom in a like a summarized manner. So once you can able to recollect all the things, then we can able to start with one big full-fledged problem, then couple of problems for PC, then we'll continue our journey with the other special problems. So I can able to allocate 2 more sessions for the same amalgamation itself. We can simply complete it on time. We can spare good time with other chapters as well. Bye bye guys. Have a nice day.